the next FMCG company that I was talking to you about is really Dabur. The numbers look very good. Sales numbers coming in up 30%. Street expectations were at 1,160, but Mr. Duggal, you have done about 1,200 crore. Thanks for joining us. Take us through the numbers, the margin picture as well.
Well, the top line growth, as you just mentioned, is a little over 31%, and our profit growth is around close to 20%. So a strong set of numbers, significantly driven by the acquired businesses, but even otherwise the organic performance has been good under the circumstances.
Okay.
Now the margin pressures remain. We all understand the scenario in terms of inflation, which is not fully neutralized by price increases. So we have margin pressures substantially negated by a better management of costs, so that the EBIT levels are pretty much the same as what they were last year.
Okay. To some extent, your sales growth was due to the consolidation of the Hobby Cosmetic and the Namaste acquisitions?
That's true.
If bereft of that also, would you have seen a growth as good as this?
No, the 31% growth has been driven, approximately 17% of that has come from the acquired companies and 14% through the existing businesses. So obviously a large part of our growth has come from the acquisitions.
How are you sensing the way margins will shape up for the rest of the year, Mr. Duggal? Do you expect commodity pressure to continue or just remain at the current elevated levels? As well, do you sense you will be able to pass on your price rises?
I think the commodity pressures are going to continue, even though at a reduced level. It'll continue to rise, but the rate of rise would slow down. I think we will need to take up another round of price increases later in the year, perhaps around October, which we are hoping to avoid, but it looks pretty inevitable. So we would see another quarter of margin pressures before the price changes happening in September, October, neutralize them, and then we would see margins recovering in the latter part of the year. But inflation is not going to come under control in a hurry. That's our outlook.
At this point, if you were to take price increases, what kind of a price increase do you want in order to negate the input cost impact? And also, how has Middle East performed? Has there been any kind of improvement there?
Right. I think to answer your first question, we need to take up prices by another 5 to 6%. Whether we'll be able to do that in its entirety or whether only partially remains to be seen. We are watching the situation, and as and when the pricing opportunities present themselves, we will take them. But we won't do anything ad hoc which will damage the business or erode market share. To your second question on the Middle East situation, it remains pretty grim in some areas of North Africa, the Levant region, Nepal, etc. But we do see signs of recovery. Nepal is pretty much back to normal after a very disturbed first quarter. And whereas Libya, Yemen and Syria remained under pressure, we are not hoping to get any sales from these three markets in the next quarter, but hopefully things will improve in the second half of the year. Fortunately, the Middle Eastern business is not significantly impacted because we've been able to make up the slack from other parts of Africa and the Middle East. So overall, the revenue growth from the overseas business would remain robust.
Can you take us through the market share numbers as well for your key categories, hair oil, shampoo, skin?
Well, in hair oils, they've been pretty constant. There's been no shift in shares. We've in the area of toothpaste, we have gained around 80 bips in terms of market share toothpastes. We have also gained in categories like glucose, honey, some skincare areas. So overall, there's been growth in market share, albeit small. And I think the only area where market share has not grown but has dipped marginally has been shampoos.
Mr. Duggal, there is some speculation on the street that Dabur may be considering hiving off some, you have a fairly diversified player in segments where you could face some kind of competitive pressures. You could be looking at hiving those off. Is that on the cards? Is that a possibility at all?
Not really. I think in our core segments of HPC particularly, we face the maximum amount of competition. So there is no peripheral business which needs hiving off. In fact, some of the smaller businesses like food and beverage and home care happen to be actually the fastest growing and perhaps both in terms of revenues and profitability. So there is no thoughts at all of spinning them off. But we need to harmonize the business. We need to have better alignment in the portfolio, which we are beginning to do in as far as the domestic business is concerned.
So would alignment also mean sacrificing some small brands, or would it mean acquisition of new ones?
I don't think acquisition seems to be a possibility as far as the India market is concerned. The targets are few and the valuations are quite stratospheric. I won't rule out acquisitions overseas, but nothing immediately on the horizon. But we would, as part of overall rationalization, cull a few brands which are underperforming, but they won't be of any significant nature. And I think the additions in terms of the portfolio would be perhaps more than the deletions.
All right. So, we'll leave it at that. Thank you very much for joining us.
Thank you.
All right, that's the word coming on Dabur. Top line quite clearly better than what the street was expecting. And I think the Diwan housing numbers that were flashing by was in line with expectation. Profit was expected to come in at 65 crore. It's come in at 66 crore.
One word that I wanted to speak was on Gail Lata. Petchem margins at 38, so that's a bit of a disappointment. We've seen a contraction about 6 percentage points last quarter, 42. Now it's come down to 38, so there is pressure on the Petchem side. Let's end Midcap Radar here. NSE closing bell takes the action.